And we're so glad to be here today. We're supposed to have 4 people. We're hoping that Sean is just caught on traffic coming up from San Marcos today, but he was going to join us as well. So we have a great panel today. Today we're going to be talking about opportunity metrics, identifying and measuring growth potential. And so we have a very great panel here today. I'm so excited about my panel. They're really awesome. In case you don't remember Bill Thompson, he is from the SBDC. He's also a consultant himself. So he's going to be bringing a perspective from that with us. And then we have Chris, and you have to say your last name.
Last name is Migliazzo.
Thank you.
You're welcome.
And he is with Hancock Whitney Bank. And so because you're in the commercial space.
That's right. Correct.
And so what's really going to be fun about this panel here today is that we're going to be able to bring in some commercial aspects, banking aspects, because if you're trying to grow and find new revenue streams, you're probably going to need a loan or some type of equity infusion to help you grow to get that. So I'm really glad that Chris is joining us today.
Appreciate it.
Glad to have you here. Okay, so let's go ahead and everyone's already put their comments in the chat. Also in the chat, we're so glad to have you here. Thank you so much. We know that you can spend time doing other things and you decided to do it here. I put in here my website. I did until I did that. There it goes. So if you want to go to my website, and if you go down to the bottom to get to the newsletter, you can keep up with us about other panels that we're going to be having in the future. So you'll know other things that we're doing. We'd love to have you join us and find out more information. So if you would like to have that, please go to my website and go down to the very bottom and just sign up for the newsletter. Okay, so let's get started. Are you ready? Okay, so I always give everybody the questions ahead of time, but I always warn people that I go off script a lot. Usually I get the first questions off script, but today I'm not going to do that to you guys. Well, just because Chris is new and he doesn't know me as well yet. So I got to give him a few questions and then I'll start going off the path. So what's the biggest mistake you see businesses make when trying to identify growth opportunities? Bill?
I think one of the biggest mistakes I see them making is not understanding the infrastructure that's going to take to be successful at those opportunities. It's like there goes another squirrel or flashing object, as opposed to looking down deep and what's the market for? Is there a market there for it? How big is that market? Can you attack that market and have enough for profits? That's just one of the biggest mistakes I see.
And what do you see from a banking standpoint?
Sure. So you kind of mentioned, in your introduction there is, capital. It's going to be important that the business going into the growth mode has enough capital, be that working capital and or, having the right human capital, for example, as well, to make sure that they're able to implement the strategy to grow, whether that's organically through the business or acquiring another business. And if it's to acquire business to grow, that's going to certainly require more capital than it is to grow organically. So it's making sure that the business is ready to support the growth. It could be through cash flow, but it also could be through borrowing from a banker or another source.
Yeah, I think the biggest problem that I see, and I think you hit it there. So I do valuations, and with my valuations, the last couple I've had, they didn't have balance sheets. They hadn't even looked at their balance sheet. They didn't even know what was on their balance sheet. And it's from the balance sheet that you really grow. If you're on a plan for growth, you've got to be looking at that balance sheet. So it's very important to do that. And another problem I see too, when I've been working with, I do a lot in the STEM space, is that people come up with this IP and they go, oh, everybody's going to want this. Okay, everybody counts, you and all your friends. But who outside of that really needs it, and really trying to understand where that need is.
Maybe all your friends.
Yeah, maybe
Maybe all your friends.
Right, because they just sit in their little bubble, because I work with researchers and they sit in their little bubble or in their lab, right? And they go, well, everybody wants this. It was like, well, who is everybody? Have you talked to anybody? No, you've got to get out there and you've got to talk to them and find out what's going on. Okay, so let's start with the basics. Bill, from your SBDC background and business valuation background, because you've done both, he's also a certified valuation analyst as well. What core metrics should every business owner be tracking to identify growth opportunities they might be missing?
Kind of playing off what Chris said, as far as having the capital to pursue that opportunity, but you said human capital as well, having the resources that can know that market if it's a different market. And you mentioned organic growth. When you first open a business, you're going to have organic growth, but then you're going to have to come to a point that you're going to have inorganic growth that you're going to have to plan to grow to the next stage. And so the biggest metric that I see is really getting in and identifying and exploring whatever that opportunity is and how much capital it's going to take, both the human capital, assets, fixed assets, and also finance capital.
So Chris, when people do come in to see you and they go, oh, I have this great idea and I want to really increase my revenue and I want to go to this market, I want to go this market, I want to go this market, what do you say to them?
Slow down. It's important to really analyze, if it's going to be a worthwhile situation, because, you hear stories all the time of people growing, franchises are a good example where they, they got a good concept in one market and they, think that everybody across the country is going to want it. And they go and open all these restaurants and borrow money from banks and other sources and raise equity from other sources, friends and family or institutional equity providers. And then they grow to other markets and that market doesn't want that concept, or they need to provide something different because, the United States is still regional. And so not everybody here in Austin is going to like the same thing that they like in, New York or Chicago. So it's important to make sure that there really is a market, and that's going to require market research. And to do that is going to cost some money.
Yes, market research. Yes, that's one thing that we always talk when we're working with researchers is that they want to do surveys. It's like, don't do surveys. Have you ever done surveys? Come on, all of you listening, if you've done a survey, have you been totally honest? Or do you get survey fatigue and then just start answering questions? Right? I know all of you done it. I've done it. I don't know about you guys. But after a while, it's just like, oh, I cannot answer another question. So you just start answering it. So you want to make sure you do that. Let me see. So there is a concept called fail fast, learn fast. How do you see metrics to quickly validate or invalidate potential opportunities before making major investments? I think that's a great question. How do you test it? What do you recommend, Bill, to your clients? When they say they want to start this new market, how do you have them tested?
Get out and talk to people. Get out and talk to 50 to 100 people. I was working with a gentleman one time that was going to go spend $300,000 to start this business, going to $700,000 in debt. I did some secondary research on it for him. And then I turned to him, I said, you need to go out and talk to 50 to 100 people to find out if they're going to buy your product. And he goes, I can't do that. And I said, you're going to go borrow $700,000 and spend $300,000. You can't go talk to 50 to 100 people. And he said, no. And he fired me and he never started his business. So they're willing to go out and talk to people and like you said, not send them surveys. I was working with a gentleman at Texas State who wanted to do a fly fishing shop and fly fishing guide service. And he went in front of Bass Pro Shop and surveyed 150 people about, what they look for in a guide. What would they look for? How much do they pay? Where do you like to fish? What type of fishing do you like to do? And he's very successful.
Yeah, getting out of your comfort zone, right? And you don't tell them what you're doing. You don't tell them about your baby.
Right.
That's the hard part. When you're going out and trying to validate a market, you go out and ask, what is the biggest problem you have in this area, right? Sure. What is that biggest problem?
Even within a market, if you're going to expand, from West Austin to East Austin, it's a vastly different approach and clientele for that matter. And so, even if you are set up in an area within a market, maybe if you can't do it, but have somebody that you trust go and live in that place that you're going to think about your second location, whether it be across town go hang out at that retail center that you're thinking about going into, and see how many people come and what time of the day they're coming, and what other drivers are there that are bringing people to that center. HEB, for example, is a great driver of traffic, right? So those typically are good places to set up retail and expand. But yeah, it's just getting out there and kind of scouting out what you think is next.
That is awesome. That's a great idea. I mean, exactly, right? Just sitting out in your car and see what's going on. What type of people, what time they're coming. I mean, doing your research, get out there, get out of your comfort zone. Because the one thing when a business fails, it fails because of something they did not know about, right? Is what you don't know is going to make you fail that business. So go out and listen. What do you not know? Don't listen for confirmation. It's confirmation bias. We're always listening to other people when they're talking, right? We're trying to get confirmation bias all the time. So listen for what you don't know. That's what's so important. Oh, I see Rachel's here. Hi, Rachel.
Hi, Rachel.
Rachel is going to be coming and being on one of our panels in the future. So we're so glad to have you here. So thank you for joining us so much. Yes, and like Rachel did, she put in there what she does and where she's from. And so if you have a business that you're working with and you're here to hear more about for your business, please put that in the chat too, so you can share that with everybody else here. Yes, and it's Happy Friday. It's Great Friday. So here's another great question. How can businesses use their financial data and banking relationships to identify and measure growth opportunities? What financial metrics are the most telling? So when someone comes in and brings you their financials, what financials are you looking at, and what key parts are you looking for?
Sure. So when coming to a bank, the several important pieces are obviously the balance sheet, as you mentioned earlier, is extremely important, and a profit and loss statement are the two that are really top of the food chain when it comes to a bank evaluating if a business can support growth or more capital. And so it's important to make sure that those are accurate. You'd be surprised at some of the stuff we see. Someone gives me a balance sheet that doesn't balance. How are you going to give a statement that has balance in the word and it doesn't balance? So start there. A bank sees something, they can't unsee it. Once we take a look at it, now we're asking questions that maybe shouldn't have been asked or don't need to be asked. But once we get a piece of financial data that you've supplied on a sheet of paper or electronically through PDF these days, if we see that the balance sheet doesn't balance, we're going to have questions, going forward of your wherewithal to provide us with accurate statements. We can't be there in the business to see that it's operating well or how it's doing. Those statements that you provide us, those are our eyes and ears in the business. We want you to operate the business, but we've got to understand if you're able to pay us back, essentially.
Yes, and when I'm doing a business valuation, that's something I look at too. Recently, I had some financials that I got, and it was done by a CPA, right? CPA had the balance sheet on the tax returns, and they had the tax returns for the year. So on the balance sheet, it had, I think it was, I don't remember the actual number, so we're just going to pull numbers out. So he had $400,000 in assets and $100,000 in accumulated depreciation. The depreciation for the current year on their tax return, $410,000. So that's what we're talking about, not matching, right? You've got to have them match up. I mean, the CPA, I cannot believe a CPA would do that. I mean, I'm looking at financials like the cumulative depreciation. So since the beginning of this business till today was only $100,000, but yet they're writing off $400,000 this year.
That doesn't matter there.
Right.
Yeah, there's an issue there. And so that's really important. Bill, so when you look at financials and someone's coming in, how do you advise them?
Well, what Chris says right on. We also will look at a cash flow budget, how the cash is flowing through the business month to month, whether it's an existing business or it's a projected, whether they're going to start a business. That gives them an idea of where the seasonality is going to be, where they're going to have low cash in some months, where they maybe need a working capital loan or a line of credit to get them over that hump, so to speak. So that's critical as well. And always keep in mind that with a bank, they need at least usually a 1.25 debt coverage ratio to make sure that they're going to be able to pay the debts and have some money left over. Nothing worse than working for the bank and you don't make any money off of it. So that's what we use the cash flow budget for.
Yeah, and I think I saw Mike Reiner, right, from Frost Bank. And I remember talking with somebody at Frost Bank. We were talking about business valuations, and they were talking about what they're looking at. And it's the same thing. We're doing a valuation. Before I give out a number, a value for a business, I put it through a purchase justification test. I look to see what kind of return they're going to be get. Do they have the cash flow, based on projection, forecast, what kind of return of investment that is. So I'm always looking at that. And I remember when I was talking with Kelly at Frost Bank, and she was talking about that's something that they really do, is they really look to see, now, if we give you this loan, can we pay it back? Are you capable of paying it back? And so it's a matter of not just looking at the financials, but something else that I think you said, Chris, is that we look at the people. Do they have the people in place, right? Do you have the right people in place for this added revenue? Do you have the teamwork? Who's on your team? And I know we mentioned this before when we were talking about leadership, but when you're going to hire people and you're trying to bring on board new people, don't go for hiring of convenience, right? You want to get the best person in there. Don't
hire somebody that has a different perspective than you, because you're going to bounce ideas off of each other, and having a well-rounded perspective is going to help a lot.
Yes, do not hire yes people. Do not hire your sister-in-law or brother-in-law. So how do you recommend to businesses? So they have a core business and now they want to add a whole new revenue stream. How do you balance that? How do you balance still focusing on your main bread and butter, but then also bringing on an added revenue stream? What do you recommend to people?
Well, the tool that I use, I like the tool for this business model canvas. First of all, starting to put it on the canvas to look at the revenues, that are possible revenues, the cost structure, the resources you're going to need to go after that market, what actions you're going to need to take, what partners you're going to need, to look at the market, really look at that. We've talked about it, repeating ourselves. We look at that market, what that market segment is, and also the market analysis of how big is that market? Is it big enough to support? And do you have the capacity? What is the capacity? You got to look at your operating capacity now. If you're running at 80-90% capacity and you want to bring on another branch, you've got to look and see how you're going to be able to increase that capacity. And it may be collaborating with some of your competition. You can collaborate with some of your competition in certain ways that benefits both of you.
Since Rachel is on the line, Rachel and I are in a book club together. And the last book we read was The One Thing. And about the book, The One Thing, it talks about, it's Gary Keller and his partner. Oh, Rachel, you'll have to put his name in it. I can't remember right now. Yes, Jay Pappison. But those two, and Jay came to our book club and we talked with him. And I think if you can get that book, The One Thing, because I think this is something that should be brought up. We're trying to find new opportunities, new revenue streams. You have to go back to what is your core? What is your core business? And what is it you are in the business of doing? So when you do possibly have this new revenue stream coming in, does it fit with your core? Does it fit with what your business really is? What's it going to do to your brand? But yes, and Coach Samer saying big facts. I do believe that was the issue with that company. They're trying to do too much without having the capacity to do well. Right. The One Thing. Yes. Thank you, Rachel, for putting that in there. But it's a great book. And so if you do have a business, read that book, because you've got to think about what it is. Because Bill had mentioned earlier, I think it was before we started, but you're talking about every little shiny thing that comes along, right? So if something new comes along and you want to do it, does it fit with what your mission is and what you are for the business? So that's so important to be look at that. Okay, what is one specific metric or measurement technique that businesses could implement this month to better identify growth opportunities?
So I can jump in there. Tracking each different revenue stream on a granular basis to see where you're actually doing well. And so when you start tracking that, you understand where to focus, where to put some more resources, or where to take away resources from. And so it's allowing you to see what if you're selling something, what is selling that is profitable, and so that will help you identify ways to grow and what other products or services that you can sell that will also be profitable. It will give you a head start there.
So when you give a loan, Chris, to a bank, I mean, not to a bank, your bank gives it to the company, and they're trying to increase revenue by adding a revenue stream that fits within their core business.
Sure.
And do you follow up with them? Like, do you check in with them every once in a while just to see how they're doing?
Sure, absolutely. I mean, part of the loan process is then we're going to collect financials either on a quarterly or a semi-annual basis, and then of course we're going to want to see that the business is doing well and generating that new revenue that they said they were going to be.
And what are some of the numbers that you look for? I mean, not specific numbers like that you want to have a current ratio of 2.
Sure.
But
well, so trends. We look at trends a lot, and so increasing revenue is always going to be something that we look for, right? You said you're going to increase revenue. Are you really increasing revenue? And then kind of flows down from there, right? So if you increase revenue, margins could stay the same where they can increase, but we want to make sure that you are bringing more to the bottom line with that increasing revenue. What's the point of increasing your revenue if the margin starts to decrease? Then you're kind of in the same place, really. And so and then you're increasing margins that'll lead to free cash flow, and eventually that free cash flow is going to lead to cash, and that is what we're all in business for, is to make money. And so those are the things that we would look for.
Now, if you see somebody that they're not doing really well, what do you do? Do you do like, not counseling, but what do you do when someone's not doing well? Do you try to like help them somehow? Do you bring in consultants? What is it that you do to?
Sure. Yes, we, if a business is struggling, that is a client or customer of ours, we work with them, because that's obviously the best way for the bank to get paid back, is to help them. And so, yes, we have resources that we would identify. We turnaround consultants or other folks that are sales coaches or fractional revenue chief revenue officers. So we would make introductions there, and hopefully that they can put some processes and a plan in place to help them through the bump in the road.
Okay, so you brought up fractional. Not everybody knows what a fractional person is. Could you explain that?
Sure. So it's becoming more of a thing, frankly, these days than I've seen in the past. But a fractional CFO or a fractional sales leader or a fractional chief revenue officer, and those folks specialize in that one aspect of the business and will essentially consult the business in that one aspect. And since they are experts, they're usually typically pretty good at identifying strengths, weaknesses, and opportunities within that situation. And so small businesses, they can't afford most of the time a full-time CFO. Those people are expensive. So they'll hire a fractional CFO that will sell a couple of hours a week,
Right.
Of their time and get in behind the numbers. And sometimes that's all a small business needs is a couple of hours from a high-level CFO, and that's what that provides.
So that's great. Thank you. Bill, we've done Profit Mastery together.
Mm-hmm.
So as a company grows, they have to become more efficient. Could you address that?
Yeah, as the company grows, the revenues, automatically their expenses are going to grow exponentially. So we do workout strategies for companies that are in trouble. But so we'll go in and look at the expenses and look what their expenses are doing and help them get those expenses as trimmed as possible before they start that growth. Because once you start that growth, those costs are going to expand exponentially. And so the best way to start is before you grow is look at your costs, look at your cost of goods sold, your operational costs, see where you can tighten those up as much as possible before you start that growth. And you really want to be aware of hyper growth. If you grow too fast, you can grow yourself into bankruptcy because of the cash cycle.
That happened when I was in working on my PhD, there was another lady in marketing that was working on her PhD at the same time. Her husband had a fence company. And he said he already had a PhD. He was a post-pole digger. So, but that's what happened to him. He was doing retail and he had so much business coming in that he did go bankrupt. And what he did is that he closed, reorganized, and came back as a commercial fencer instead. And he did that. So in terms of getting efficiencies as you're growing, what are some of the ways that a company can become more efficient? What suggestions do you have?
A couple of things. One is on your customer base. You're going to have customers. Generally, you're going to have your A customers, B customers, C customers. C customers will pay you late. B customers don't pay you very fast. You want to focus on your A customers, getting into those, and start farming out those customers that don't pay on time. And so, because if they're not paying on time, I was doing one on a tire company, and he had large contracts with the city and the county, but they didn't pay for 90 days, and he was covering their inventory for 90 days. And so I suggested he could charge them more money to cover for that because he didn't want to let them go. So that's one thing we look at as far as on the customer side, and then also just the individual costs. What capacity are your assets operating at? If you're a machine shop and you've got a lathe operating 20% of the time, well, how can you get that lathe operating up to 80% of the time? And you may take on jobs for other machine shops that they don't want to do to bring that capacity up. So it's how do you increase the capacity of your assets that you have?
So it brings up two different concepts that come to my mind right now. What is your cash flow cycle? Mm-hmm. And standardizations, SOPs. Do you want to address what cash flow cycle is?
Sure. So it's it's the length of time that it takes from selling a service or product to turning it actually into cash that you receive. And so in a manufacturing operation, there's the lead time of actually getting the order, and then manufacturing the product, shipping the product, getting it to the customer, and then having their terms, whether it be a week to pay you or 60 days to pay you. And so from the time that you have to put the money out to start manufacturing the product, all the way to the time that you get paid on the back end for the product is your cash conversion. And that is important to keep an eye on, because the longer that gets, the more expensive it gets.
And that's why whenever you're seeing people when I see a hockey stick for the revenue projections, I know they have no idea what their cash flow cycle is. Because if they're having it going up that fast, they're not thinking about the cash infusion that they need to balance it, right? Because you have to have all that cash up front. You have to get the inventory. You have to pay the people. You have to do everything else, your overhead, everything like that. And you don't get paid for 30, 60, 90, 120 days later.
Totally.
Right. And so how are you going to finance that?
Right. Yeah. One of my favorite things to tell business owners, and it's kind of surprising, but the fastest way to make money is to collect the money that you've already sold the service for. You can't let your payables continue to stretch. If people are past due, you need to have someone in the business that is calling on those folks to make sure that you get paid for what the services or the good that you've already provided.
And Profit Mastery, I know I keep bringing up Profit Mastery, but it's a great class. And that's one thing they do address in that class, right?
Mm-hmm. Yeah.
And they talk about how to do that.
Yeah. One thing you're talking about the manufacturing as far as being efficient is watch your shrinkage, watch your waste. If you're cutting metal out of for whatever, from a machine shop, how much waste do you have, and how do you minify that waste? And people steal. So how are you going to protect yourself against theft? The problem is if it's broke, they won't steal it. but if it's not broke, they don't try to steal it. So, but I mean, it's just, you make the joke about that, but really shrinkage as far as where your waste is.
Right. All right. Standard operating procedures. Why is that important as you're growing?
You just asked a question.
Oh, sorry.
I didn't hear what you said because I read your question.
No, Profit Mastery is not part of this series, but the SBDC does offer those classes. So do look into Profit Mastery, your local SBDC. They should be offering that for you.
It's 16 hours we do it over 4 days. doing 16 hours of it's a very good, a banker out of Seattle created it, Steve Lefevre, and it's a good way for layman's terms understanding financials.
It really is. I mean, because I have a background in accounting. I do all sorts of stuff in numbers. And when I took Profit Mastery, and I did answer the questions faster than you did, but it was explained in such a way that it was very easy to understand. I mean, that was the beauty of it. It was just like, it just made it so easy to understand. So we want to get, all right, so how are we doing on time? Oh, we still have lots of time. Great. So let's get back to revenue. How do we find out, how do you decide if there's another revenue source or not, Bill? What are you going to do? How do you, someone comes in and they go, I want to increase my revenue. What do I need to do? What would you suggest to them?
Well, there's 4 ways to increase your, I guess, profits. One is to turn more profits, sell more, but you're also going to incur more costs. Increase your margins, or decrease your COGS, or decrease your operational expenses. Those are the ways to increase your profits. But your question was more about increasing revenue.
Right.
So in revenues, it's the same thing, but if you either grow vertically or you grow horizontally. You increase your revenues vertically by producing more, we just talked about, or horizontally, where you're looking at complementary items that make sense, that you have a market for, and you can easily transfer into. And you really have to watch out for the bright, shiny objects and make sure you think it through before you do that.
What about, immediately what I was thinking about too, as you were talking, is ask your customers. Ask your customers about what do they need? What is the biggest problem that they have? What is it that they ask for when they come into your store or your place that you don't have? That might start telling you where you need to start looking. Look at your competition. Study your competition.
My dad was a hardware salesman. He sold to hardware retailers. And he taught me in 4th grade, GMROI, gross margin return on your investment, which is basically, if you sell 3 hammers a week, don't buy a box of 12. Buy 3 hammers plus 1 overstock, and take that other cash and buy a level, or buy levels, or something that's complementary to that hammer, because what you're looking for is that turn of inventory. And if you can turn that inventory in a week, you're getting your profit back in a week instead of having 12 hammers, which you're not going to get that profit back for 4 weeks. So it's planning that way as well.
Oh, wow. I like that. That was great.
And my dad.
Back in 4th grade.
Yeah.
Okay. I'll let you win that one. Bill won. Yes. Yes. So Chris, what are other ways that people might be able to find other revenue streams?
Sure. So again, he hit it on the head. It's complementary services or products to what you're already selling. There's no reason to be selling hamburgers, and then it's a great idea to start selling any other type of food group that's not complementary, right? You're going to sell hamburgers and maybe add French fries, hot dogs, but you're not going to probably add, if you're a fast service restaurant, you're not going to add steak to that menu item, right? It's going to be the fast food stuff. So stay in your lane essentially, and add complementary products to what you're already doing.
Right. And really do look at your competition. I really encourage you, look at what your competition is doing. Learn from that. Ask your customers when they come in, like what else, when they come in, they ask for something, you don't have it, or ask them what's the greatest problem they have when they're using your product or your service. If you just start talking to people, and do your research as well. I mean, go out and see what the competitors are doing. For instance, when I used to teach the business plan development class, I would have people look at a comparable market. So Seattle, Washington is comparable to Austin, Texas. Go to Seattle, Washington. You don't have to actually go there, but I would. Wouldn't you? Yeah, I love Seattle. Oh my gosh. Especially in the summertime, that might be a great time to go when it gets so hot here in Austin. But go there and see what's going on in those markets. See what innovative ideas are going there, and see what other ideas other people have. Because once somebody has a great idea, it's important to take that idea and build on it, right? So that's real important. Go and see what's going on. And if go to trade shows, but get out of your comfort zone. I mean, I think that's going to be my biggest takeaway for you guys today is get out there. Go out there and talk to other people. Go see what your competition is doing. You know, even talk with them, because a lot of times we say, what is the greatest problem you have in providing your product or service? And maybe you can find other ways, you know, to have that collaboration and things of that sort.
Yeah, can I address a couple of the questions on there about
Sure.
the fractional folks? I see a couple of questions about the fractional aspect of what people do.
Thank you,
And
Chris.
when is it time to maybe engage one of those folks, or how are they going to come in and understand your business? Well, so the revenue officer, they are going to take a look at the history of the business and understand where the revenue was in the past, and what the profitability or the viability of the company looked like then. And they're going to work with you as the business owner to kind of draft a plan of, how do we maybe get back to the revenue of the past, or how do we increase the revenue going forward? And so they're gonna work closely with you to understand, what type of revenue you need to kind of be successful, and what your goals are. And so they'll work hand in hand with you. And then the other thing was, with a fractional CFO over a bookkeeper, for example, the bookkeeper is really, all they're doing kind of is collecting the numbers and organizing them for you into your financial statements. That's a very important role, absolutely key and vital to a business. But a CFO is going to take those numbers and help you plan as a business owner. The bookkeeper is, like I said, just collecting those numbers and putting them into a form where you can understand them. The CFO is going to digest those numbers and help you plan for the future, whether it be what kind of capital outlays do you need to acquire a business, or to acquire a new piece of machinery to start a new manufacturing line. And so that's kind of where the breaking point is, going from a bookkeeper to maybe engaging a fractional CFO.
Oh, great. Thank you so much. Go ahead.
That's a great point. And the fractional CFO will help you do your planning. CPAs are generally doing your tax work. They're not necessarily doing your financial planning. And so it's really important to have the bookkeeper, the CPA, and if you need a fractional CFO, that makes perfect sense.
And if you go back and look at some of our past panels, we've had John Spencer on. Was that in February, I think?
I don't remember.
Yeah, John Spencer was on, and he is a fractional revenue officer. He's a fractional officer. And George Stevens was on one of our previous panels as well, and he's with now CFO. So you can go back and look at some of those previous panels that we've had, because I think George came in January,
Right.
because we were talking about finances. George was with us those two times. So and I really encourage you to find John Spencer on LinkedIn. He posts all the time, and he has some really great ideas about having a chief revenue officer, and what other things that you can do with sales and things of that sort. So please go find John Spencer on LinkedIn. In fact, I will, as we always do after all these panels, I try to take notes during it, and then I put together an email that I'll send to Jane, and she will send it out to everybody, and I will have John Spencer's LinkedIn on that, and I'll also put in George Stevens. Yeah, because that's really good. I mean, but what about marketing? Would you encourage people to hire somebody in marketing to help you find revenue streams?
Sure. Marketing is very important. Kind of the way of the world today is social media. And so, frankly, I highly recommend, finding somebody that is skilled in that aspect of it, and that can help you, market the business and product, and that can be targeted marketing as well. And so those folks will know how to get to the people that you're looking for.
How do you decide which marketing person? Because when you go out and you put out marketing, to me it's a wide world. I mean, you say the word marketing, it's like saying the word doctor. There's a lot of different types of doctors, medical doctors, education doctors, lawyers.
Sure, there's different marketers that specialize in, say, for example, social media or television marketing or radio marketing, right, or print marketing. So people have their specialties. So it's about interviewing them and asking the right questions to know that what you're looking for is what they can provide.
I want to list the customers they've worked with, and how it goes, because and this is not all on the marketers, it's also on the entrepreneur, is that if you don't have a comprehensive marketing strategy and you come in and you do a social media plan, you spend the money to get a website. If you haven't done the background on the total comprehensive strategy, which includes goals, objectives, strategies, techniques, and if you don't look at the whole thing, then it's like to fall flat. And so the entrepreneur needs to understand there's no quick fix on marketing. Marketing is like a multi-headed hydra. You cut off one head and four more grow back. It's a constant cycle because the market is constantly changing. Competition is constantly coming in. And it's not something you just do one time and let it go. You've got to keep that cycle going. You look at Coca-Cola. Coca-Cola at one point, I was in a marketing class back in the dark ages, and Coca-Cola cut off their marketing for a while, and Pepsi caught them. And so then they came back in and started doing the marketing again, because it's something that it is a cycle.
Yes, you cannot just put it on autopilot.
Right.
All right, so since we've been talking about like hiring people like a fractional CEO, I know this is totally off our market. How do people find some? I know I do that, right?
Yeah.
Yeah, I know. It's just like the little shiny objects go on my brain, and I'm
Okay.
just like rocking all over the room. But so if people out here are considering, like, right now we're thinking about, we might have to hire someone in marketing to help us find out different revenue sources. We might need a CFO. We might need a CRO. How do we find that person? How do you recommend? What should somebody look for when you recommend somebody?
Working with people that you like is important, and so reaching out to folks that you already have in your network. They're likely to know somebody or have already worked with somebody. So ask your circle of influence and people that you trust. Who they know and who they would go to.
You brought up networking. Networking is important. So if you're running a business and you're just so caught up in the day-to-day and you're not networking, not a good thing.
Correct.
So how do you get people out when you say that you want somebody to go networking? What kind of networking should they be doing?
Well, find groups that are worthwhile, and that might be going to test a couple of different networking groups for that matter, and to see if those are like-minded people and people that are trying to do the same thing that you're doing.
Yeah, get in a networking group that is congruent. The members are congruent with your market. I had joined one great networking group, but it wasn't the clientele was not. We couldn't cross refer to each other. I could maybe one or two, but it wasn't a continual thing. If you, like, for example, if you're an attorney, you're doing real estate, you may want to network with a group that has commercial real estate agents, have title people, have mortgage bankers, somebody so that you can cross refer to each other. There's something else I was going to say and I lost it, but so on the networking part is finding a group that the members understand what networking is, which is not selling. There's a difference between selling and networking. And if people who are professional networkers know the difference and work in those groups where you're not necessarily trying to make the sell every time, but you're helping the other guy make a sell maybe, and that will come around over the long term to benefit you as well.
What kind of questions should we ask? What are some of the questions that would be important that when you're interviewing somebody, like to be a CFO, a CRO, marketing agency? What kind of questions? I think, Bill, you had one. You said, who are some of the other clients they've done?
Mm-hmm.
And looking to see if they're comparable type of businesses, maybe not competitors, but they have maybe their service or their manufacturing. So they
Right.
have that experience in there. And then you, Chris, you were talking about personality.
Yeah, what their, what their goals are and what they're looking to get out of the relationship as well is important. And right, it's more fun to work with people that you know and like.
Yes. And get that trust,
That's
right? So take the time to really get to know the person first before you hire them. Get to know them. Do you like them? Do you like them as a person? When they communicate, do they talk down to you? Do they talk up to you? Do they talk at you? Right? Looking at all those kind of things. Do research on them. Look at their LinkedIn account. How many times do they
Sometimes
post?
a Google search goes a long way.
Yes.
Yeah.
You know, it's amazing how many times people don't do that. So, I mean, I just assume everybody does that. You know, like when I'm going to go have a meeting with somebody, I go and do research on that. Yeah, because if you have professional LinkedIn, you know I've been all over your LinkedIn account, right? Yeah. So I mean, that's real important. Do your homework just like you would for anything else.
Yeah, you can ask them like, what's their ideal customer look like? What industry do they want to work in? You know, what size of business? So the early stage business or late stage business? What, there's, people like to talk about themselves and what they want to do. What's their passion? How'd they get into this? I was at an event the other day and we're talking about this young lady she was a young lady and she was doing abrasive on tanks, like painting the paint on tanks to keep it from rusting and ships and stuff. And I said, why did you get into that? You know, and I said, there's no undergraduate course for that. And she just lit up and she just told me all about it. And, because people like to talk about themselves. And so you get to let people talk about themselves and find out why they do what they do. What is their why? The passion they do.
Oh yeah, what is their why? I mean, that's a really good question, right? And that's something we need to ask ourselves too.
Mhm.
You know, like even when you're trying to pick another revenue stream that you're trying to add on or find other opportunities. Why would somebody want to use that, or why do they need that, and things of that sort. And look at it complementary type of things. How hard is it to add and things of that sort. So looking ahead, let's think a little bit about the future. So what's one piece of advice you give to a business owner who feels overwhelmed by all the potential metrics they could track?
Well, you said something earlier that triggered a thought is that, when you start a business, you need an attorney, you need an accountant, and you need an insurance agent. As you grow your business, you really want to grow it in phases because you can't necessarily go out and hire a CFO because you don't have the income. You may not be able to go out and hire everybody you need. So you want to stage that business and find where you can get services for low money. If you're going to be in business, you got to pay to play at some point. But you've got to also you've got to have to plan that out, these stages. And this question that you wrote down here, it's like I was working with a gentleman, and he was a very bright gentleman. He started the business. He was on the floor in operations at 9 o'clock at night filling orders. And he was in trouble with the bank. He was dealing with the bank, and the bank was fixing to shut it down. And so I pulled in and I said, well, give me a cash flow statement. He couldn't give me a cash flow statement. I said, give me a general ledger and I'll create a cash flow statement. When I did that, his general ledger was significantly off from what his bank deposits and withdrawals were. And so there was money missing and he had no idea where it is because he's on the floor at 9 o'clock at night. So it's creating systems and training people to do those systems so you can step out of the business and work on the business as opposed to in the business, and really take the time. Financials don't lie. That's what tell you. You can financials will not lie to you. Let you know exactly what's going on in the business, and it was really sad. I hope he made it. I don't know, but so anyway, that's my thoughts on that. My soapbox.
What about you, Chris?
My thought is to start tracking revenue and expenses, on a monthly basis is something that is easily achievable and something that you could start, today. An example of a business that I've worked with for a long time. He had seen his sales kind of decrease, and he was a manufacturer of like aftermarket parts for what I call grown-up toys, and that's ATVs and golf carts and pickup trucks. And he was building, or he was manufacturing the parts to lift those things and make them a little bit more exciting for the folks that were buying them. And he kind of saw that that revenue stream getting lower because he was tracking it on a monthly basis. And he as he's tracking that, he's tracking also his revenue and expenses in the business of, he was creating parts for tools, and that was lawnmowers and heavy machinery, and he saw that increasing. So he was able to kind of quickly maneuver and shift and focus more on manufacturing parts for those lawnmowers, for the landscapers, and for the heavy machinery for the construction industry. And so now the business has grown significantly because he's more focused on that market. And those folks are constantly coming back to buy from him because they need the equipment to generate their revenue. The toys, that was something that was boom maybe in 2020 when everyone was flush with cash and buying things, and that kind of went away. But tools, the lawnmowers and the machinery, that's not going away. People are going to need those for the business forever.
And I think in closing, I think we're coming up on our time right now, but one thing I'd like to summarize, I think, is coming here is you do have to have metrics. What are the metrics? Look to see what those metrics are that are important to you, and then look for trends. Watch the trends. Check it every Monday. There was a company here in town in Austin. Every Monday, they have a meeting where they go over their financials and they looked at trends. Well, they could see the recession coming, and they started bringing down capacity because they knew the recession was coming, and they made it through the recession because they could see that in the trends. And that's what's important. Figure out what's important to you. Like for me, and I'm doing business valuations, there are certain people that refer business to me. Have I gone out to talk to those people this week? How many people have I talked to? Are there new people that I've talked to? And I keep track of those numbers, and I look to see, where am I getting those referrals? Because a lot of times when I'm doing a business valuation, it's one and done. Because you don't always need a business valuation. It's not something I usually have a repeat client for, especially on the divorce side. I hope I don't have repeat divorces. Yeah, hopefully they learn from the first divorce, right, to protect the business the next time. But anyway, thank you guys so much for being here today. We so appreciate it so very, very much. And next month, come back the second Friday, and we're going to be talking about target market. And I believe Rachel is going to be with us next month. So I'm really excited about that. I'm trying to think who else is coming. I'm not sure yet. So anyway, we're going to have another, it'll be really fun. So we've got some really great people coming in to talk about target market and how to really identify that target market and what that means and how that works for you. But thank you everyone for being here today. And again, you'll be receiving an email from Jane. And Jane I'll put in here some of the things I've been writing down, some comments that our panelists have talked about. I'll put that in the email to send out to you. And yes, this will be on replay. You can go to the SBDC website, and all the past ones the videos will be out there. And you can go back and watch it and see all of our great comments once again.
Thank y'all.
Thank you everybody for joining.
Thank you everyone for being